Hi, Suzy Rhoades, your financial training expert, here with this week's questions of the week. This week, our topic is going to be the SIE exam. We're going to do a practice exam. It has 36 questions. Each of these questions represents a topic I expect you will need to know to pass the SIE exam. How do I know what you need to know? FINRA publishes a content outline. So all 36 of these topics are found within FINRA's content outline. Let's check out the exam. Which is the best description of repurchase agreements? A form of short-term borrowing for dealers in government securities. Money market instruments sold by commercial banks. Letters of credit used to finance international trade. Long-term debt issues of the United States government, the rates of which are published weekly. Repurchase agreements are a form of short-term borrowing for dealers in government securities. So you click what you believe is the correct answer, click check answer. You know you got it right because you got that green check mark. For all of the questions, you can click show explanation. You can read the rationale and you can also listen.
Which is the best description of?
Some people learn best by listening. So for these other choices, sold by commercial banks, money market instruments, that's a certificate of deposit. Letters of credit used in the import-export business. Those are called banker's acceptances. And long-term debt issues of the U.S. government, that's a U.S. government bond. Which one of the following investments offers the investor the ability to put the security back to the financial intermediary on a daily or weekly basis? A floating rate of interest as well as the stated maturity date. Choices include variable rate demand note, equity put option, fixed index option, or variable annuity. Annuities pay you monthly for life, an amount that varies, so no. Fixed index option, no. Equity put option, no. It is a variable rate demand note that this question is describing. Mitch purchased $50,000 worth of stock in company A. What is the most he can lose? What's the most you can lose when you buy anything? Whatever you paid for it. So in this case, Mitch can lose all $50,000. Securities are risky, subject to all sorts of kinds of risks, but the most important risk here would be market risk, systematic type of risk. The formula for a client's net worth. So let's talk about this. Where would you find a client's net worth? Income statement or balance sheet? Balance sheet. What's on the balance sheet? What the client owns, those are called assets, and what they owe, which are called liabilities. Assets minus liabilities. That is the client's net worth. If we were looking at a corporation's balance sheet, assets minus liabilities equals shareholders' equity. It's a different question. Similar concept though. Of the following statements, all are correct regarding ETFs except. So an ETF is an exchange-traded fund. I always suggest you reword the question into English without the except. So we're looking for what is false about an exchange-traded fund. They never have a commission to buy or sell. That's false, but let's check to make sure the other three are true. Good advice for the exam, never pick the first right answer. They are most likely a closed-end fund. They are marginable and they trade during the day at many prices. All true. So the only one of these that is false is they never have a commission to buy or sell. That is right because it's wrong. I can't tell you how many times students reach out to me and ask me or tell me that question answer is wrong. Yes, because you're looking for what is false. Don't get tricked during your exam. Be careful. Hedge funds will do all of the following except. So what does a hedge fund not do? Determine their share price a minimum of once every business day at the close of business of the New York Stock Exchange. Hedge funds don't have to do that. Open-end mutual funds have to do that. Hedge funds do not. So I'm thinking that's the right answer, but I'm going to read all four choices. Invest in risky investments and use leverage to buy securities. Yes, true. Pay the investment manager both an annual fee and a percentage of the profits. True. Require investors maintain their investment for a minimum length of time. True. So there's only one false statement, and that is this first statement. which is actually true if we're talking about an open-end mutual fund. But this was a question about hedge funds. This is false. They don't have to do that at all. ETNs are exchange-traded notes. Representative of a pool of equity securities? No, that would be an ETF, exchange-traded fund. Illiquid? No, they trade on an exchange. Shares of equity? No. ETNs are debt instruments. They are senior notes that trade in the secondary market. All of the following are true regarding variable life insurance, except what is false? It has a guaranteed minimum cash value. No, it doesn't. It has a variable cash value with no guarantee. So I'm thinking that's the right answer. I almost clicked it. No, don't click it yet. Read all your other choices. It has a variable rate of return. True. It has a guaranteed minimum death benefit. Variable life. It does. The policy's face amount is a minimum guarantee that can increase depending upon performance of the separate account. True. It must be sold with a prospectus. True. Variable life insurance is both an insurance and securities product. You have to sell variable life insurance, just like variable annuities, accompanied by the delivery of a prospectus. So we're looking for the false statement. It has a guaranteed minimum cash value is right because that's false. Which of the following is a type of non-qualified retirement plan? So there's two major categories of retirement plans: qualified, that follow ERISA, and non-qualified. A 401k, qualified. Deferred compensation, non-qualified. KEO, qualified. SEP IRA, qualified. The biggest thing about qualified versus not qualified is that non-qualified plans can be discriminatory, set up in favor of higher paid workers, where qualified plans must be the same for everyone. I cannot stress enough how every single letter in this test matters. It is so easy to have missed the words or the letters N-O-N, non, and think it said qualified. So slow down. It's not a race. You just need to pass. I'm not telling you to ignore the time. I just want you to be careful. Regarding contributions into an HSA, which is incorrect. So we're looking for the false statement. The money in an HSA remains the property of the employee, even if they switch employers. In an HSA, a health savings account, that is true. Any amount contributed by a person's employer does not affect their remaining contribution limit. That is false or incorrect. The money contributed into an HSA is tax deductible. That is true. The family contribution limit is higher than the individual limit. That is also true. So the one that is incorrect. So whatever your employer puts in does reduce the amount that you can contribute. That would be the true statement. That statement, choice that it has the green check mark, is false. The most common type of dividend paid is in warrants, rights, cash, or additional shares. The most common type of dividend paid will be in cash. It is possible that common stock can pay the dividend in additional shares. Preferred stock can only pay the dividend in cash. Which is the most important yield on a callable bond? Which is the most important yield on a callable bond? Let's do some drawing because I really do want you to use your scratch paper. So we have the bond teeter-totter. And on one side, we have price. And on the other side, we have yield and rate. And these yields actually stand for current yield, yield to maturity, and yield to call. And we need to know when is the most important time to think about yield to call. So interest rates are what drive the teeter-totter. Changes in interest rates from the changes versus the nominal yield, which is the coupon rate on the bond. So corporate bond's good for up to 30 years. You buy a corporate bond, let's say it pays 6%. That's annual interest. It's paid semi-annually, $30 every 6 months. If interest rates go up, yield on this bond, because remember, once you buy the bond, it trades in the secondary market. You can sell it at the market price at any time. So if interest rates go up, current yield, yield to maturity, yield to call, the market price has gone down. So you're probably not going to want to sell it at this point. When is it most important to be aware of yield to call? When you have a callable bond and interest rates have gone down. So if interest rates have gone down, this bond is going to trade at a premium. It's going to be more valuable than it was when it was originally issued and sold at par. Current yield is going to be less than the nominal yield. Yield to maturity is going to be even lower, and yield to call. If a bond is callable, it means that the issuer can choose to pay off the bond before maturity so that you're getting back even less, because when a bond is matured or when it is called, you get back par value. So you paid more than par to get back sooner than maturity your $1,000. It is true sometimes when they call the bond, they pay you an extra little bit of money. But when interest rates have gone down, the most important yield to consider when you are buying a bond is yield to call. If it's a callable bond, you need to understand this is also called yield to worst. Yield to worst. All right, so let's go back to the question. Make sure that I've explained what you need to know. Let's see. Which is the most important yield on a callable bond? Yield to call, yield to worst, nominal yield, or current yield? So you might be thinking there's two choices that are the same. And I don't disagree with you. But what is it called? Now remember, when we were looking at the bond that was trading, this bond here is trading at a discount price, less than par value. And the bond would still be callable, but it would never be called because interest rates have gone up. Issuers only call a bond if interest rates have gone down enough that it makes sense to refinance the debt. It's like paying off a credit card with a 0 interest credit card. Have you ever done that? I've done that. We've all done that. So when the bond is trading at a discount, yield to call is not a factor. It doesn't matter at all. The most important yield would be yield to maturity. So that when a bond is trading at a premium, what do we call yield to call? We call it, let's check the question. We call it yield to worst. Good job. That's a lot. A stock that was purchased for $100 paid $3 in dividends and had $9 in appreciation over the past year. Inflation was 3.5% over the last year. What is the stock's real return? Hold on, I got to get something. I had to go get the handy dandy non-programmable calculator. They'll give you one at the testing center or it'll be built into your computer program. So you can't take your phone, unfortunately. Darn it. So, I told you I have an accounting background. I like numbers, but I hate math. It's true. Most accountants are the same way. So we have to do first what's called total return, which is yield, which is $3 in dividends, plus growth or appreciation, which is $9. And we take the $12 and we divide it by what was paid for the stock. So $12 divided by $100. Oh, we can eyeball this, but don't do that. Just trust me and use a calculator. So far, we have total return of 12%. What is real return? Real return is total return minus inflation. So we have to subtract from 0.12, 0.035, because it said inflation was 3.5% over the past year. So 0.035 is in decimal form. So we have 0.085, the stock's real return. Some math. Yes, you can do it. When a written complaint is received, what should you do? Complain to your supervisor, toss it in the trash, let the compliance department know so documentation can be done, or notify FINRA immediately. Use your common sense. I know you want to throw it in the trash. Don't complain to your supervisor. You don't have to notify FINRA. Let the compliance department know so documentation can be done. You could tell your supervisor, true, that'd be fine, but that wasn't a choice. The CBOE will conduct fingerprint-based background checks on which of the following? So the CBOE is the Chicago Board Options Exchange. Exchange directors, exchange employees, exchange officers, and exchange temporary personnel, independent contractors, consultants, vendors, and service providers. All of them. The CBOE will conduct fingerprint-based background checks on all 4 of those parties. Bill is a Berkshire Hathaway shareholder who has attended the company's annual meeting for the last 5 years. Due to the global pandemic, he has decided he will not attend this year's meeting and signs a proxy, allowing a designated party to vote on his behalf at the shareholder meeting. At the very last minute, Bill decides to wear a mask and attend in person. Which of the following is true in this case? Both Bill and his proxy can vote. No. Bill must find the proxy and withdraw his authorization. The proxy cannot vote for Bill since Bill is attending in person, or Bill has lost his right to vote in person. So the most correct answer in this question, the proxy cannot vote for Bill since Bill is attending in person. The maximum prison sentence for violation of insider trading laws is 30 years, life, 20 years, or 10 years. The answer is 20 years. No trading based on insider information. If an investor buys a stock for $50 and sells a call on that stock for $8, his break-even point on the stock would be what? So let's make a T-chart. Let's draw. A T-chart is basically going to look at money out of a person's pocket and money in their pocket. So they bought the stock at 50, so out $50 a share. They sold an option, which is money in. The premium on the option is collected by the person selling the option. So that if the stock should go 50 minus 8 below 42, then the client will be losing money. So the break even for this position, long a stock and short an option, is the inventory position minus the premium collected. So let's go back to the question. So they bought a stock for 50 and they sold a call. So when you sell a call, you have limited your upside profit potential because if the price goes above the strike price, the shares are going to be called away. It's a covered call because the investor owns the shares. So the only downside risk insurance that selling the call provides for this long stock is the amount of premium collected. So 42 is the break even on the stock. If it trades below 42, this investor will lose money. Options are a lot. They take a lot of practice. A FINRA member firm may hold a customer's mail longer than 3 months if the customer's written instructions include a valid reason for the request. Valid reasons include all of the following except. So what is not a valid reason? Convenience, security concerns, traveling abroad, or safety concerns. Which one really stands out? Which one of these things? I know I always sing that song, but Sesame Street. Convenience? That does not seem like a valid reason, but the other 3 are okay reasons to hold the mail beyond 3 months. JT inherits stock from his aunt Annette. JT's cost basis would be which of the following? So when you inherit stock, you inherit the stock at its fair market value as of Aunt Annette's death. So fair market value of the stock as of Annette's date of death. So if she was alive and she gifted him the shares, then she would have assumed the original cost basis. So 2 different questions. Be careful. When trading currencies, which factor is primarily used to determine how much of the counter currency a customer will receive? The counter currency's inflation rate, the balance of trade between the 2 countries, the forward rate, or the spot exchange rate. That is the factor that is primarily used to determine how much of the counter currency a customer will receive. It's called the spot exchange rate. On the spot. How much can you convert your dollars into euros or euros into pounds? Whatever, one currency into another. Which of the following types of risks is systematic? So systematic risks cannot be avoided by simply diversification. Legislative risk, credit risk, inflationary risk, or business risk. It is inflationary risk that is systematic. Inflationary, you can't really avoid inflationary risk. You'd want to diversify by asset class to reduce it, but you can't avoid it. Gas gets more expensive, cars get more expensive, houses get more expensive, everything gets more expensive. Inflation, can you avoid it? No. Which type of annuity generally has the longest surrender charge period? So surrender charges are during the pay-in, when you are accumulating units, if we're talking about a variable annuity. It is the index annuity that has the longer surrender charge period as a general rule over variable and fixed products. Using the concept of market momentum, the S&P 500 rises 200 points between Tuesday and Wednesday, coupled with heavy trading. The S&P is likely to begin declining slowly, sustain an upward trend in the following days, flatten, or contract. Using the concept of market momentum, so the market's gone up 200 points with heavy trading, I believe it is going to sustain an upward trend in the following days. That is what it is most likely to do. Is it guaranteed to do that? No, of course not. It's most likely, though. When your client sells her mutual fund shares, she receives bid price minus a commission. She has sold which type of shares? Closed-end shares, sector fund, open-end shares, or diversified shares? If you're selling open-end shares, you wouldn't sell them, you'd redeem them. And what you would get is NAV per share, which is the bid price. So when you see bid minus a commission, they are closed-end shares. Closed-end shares trade in the secondary market. So there is a commission on the buy and a commission on the sell. Which of the following would be allowed under Regulation S-P? Requiring the client to pay a fee to opt out of sharing. S-P is the privacy requirements. It's the financial services industry adoption of the Gramm-Leach-Bliley Act. Requiring the client to write a letter to the firm requesting to opt out of sharing? No. Sharing a client's non-public information with a non-affiliated third party after the new account has been opened and the client has been given a reasonable amount of time to opt out of the sharing. I like that. That might be okay. Sharing a client's non-public information within days of opening up the new account? No. This is the only one that is allowed under Regulation S-P. You have to give them time to opt out of the sharing. If they haven't opted out, then you can share. In order for a registered representative to be given discretionary authority for a client's account, the client must be mentally incompetent? No. The principal must approve this situation before it will take effect. The account must be new, or the request may be oral. In order for a registered representative to be given discretionary authority, it must be in writing, and the principal must approve the situation before it will take effect. As part of a brokerage firm's customer identification program, all of the following information must be collected related to the customer before opening an account, except customer name, date of birth, social security number, or education level. Which one does not belong? Education level does not belong here. All of the following are true regarding securities markets, except what is false. The secondary market includes securities listed on the NYSE, the NASDAQ, and other exchanges. True. The primary market consists of shareholders selling shares to other shareholders. False. That is the secondary market that it's describing. Let's check the other two. The fourth market is where large institutional transactions take place. True. The third market is where exchange-listed securities trade over the counter. True. So B is right because B is false. The primary market is issuer to shareholder, the sale of the stock for the very first time. When can a registered representative share in a customer's account? With advance permission of FINRA, with the member firm's prior written consent in a joint account in proportion to the amount the registered representative has invested, always or never. So generally, this is not something that's going to be happening. However, It is allowed with the member firm's prior written consent in a joint account in proportion to the amount the registered representative has invested. Allowed under FINRA rules if all of that is true. A block order involves how many shares of stock? So a round lot is 100 shares. A block of stock is 10,000 shares or more. All of the following are forms of market manipulation except, so which one is not market manipulation? Placing a trade for the client the day it was received, seems like a good thing to do. Spreading false information, marking the close, front running. Those last three seem all bad. So placing a trade for a client the day it was received, not market manipulation. Leonard is a customer of broker-dealer ABC. He is on the federal do not call list. Ayla, a registered representative who works for broker-dealer ABC, solicits Leonard via cell phone. Leonard requests to be put on the firm's do not call list. Which of the following statements is correct regarding this request? Leonard must submit his do not call request to his firm in writing. Broker-dealer ABC must not call Leonard. I like that. Broker-dealer ABC is only allowed to call Leonard between the hours of noon and 4. No, broker-dealer ABC can continue to call Leonard since he is a customer. No, he is specifically asked. That's all he has to do to be put on the do not call list. Under Rule 503 of the Securities Act of 1933, when is an issuer required to file a notice of sale on Form D? No later than 20 business days after the first sale of securities in the offering, within 2 business days of the first trade, before sales occur, or no later than 15 days after the first sale of securities in the offering. The correct answer is no later than 15 calendar days after the first sale of securities in the offering. This paperwork is filed electronically through the Edgar system. When opening up a brokerage account for a retail customer, Form CRS must be given within 30 days of opening the account, upon request, before opening the account, or within 7 days of opening the account. Form CRS is the customer relationship summary. Of these, the only one that is correct is before opening the account. Which of the following Federal Reserve actions is most likely to cause an inverted yield curve? Wait a second, what's an inverted yield curve? Let's draw. So yield curves, for the purposes of these exams, are going to be looking at the yields on U.S. government securities. So starting from Treasury bills to notes to bonds. So when we have a yield curve that goes up, this is called a positive yield curve. And when we have a yield curve that goes down, this is called an inverted or negative yield curve. I'm a horrible drawer. I have no artistic skills at all. Inverted yield curve. Let's refresh our memory about the bond teeter-totter. So the bond teeter-totter, we have price on one side and we have yield and rate on the other. The driver of the teeter-totter is interest rates. And what causes the yields to go up, what would cause the Treasury bill yields to go up would be if short-term interest rates go up. So when does the Federal Reserve want to raise interest rates? When we are in a recession or when we have inflation? When we have inflation. If we're in a recession, they're going to lower the interest rates to stimulate spending. We call that loose monetary policy when they lower the interest rates. When they raise the interest rates, we call that tightening the monetary policy. So let's look at, remember, interest rates and yields go together. So let's look at the question again. So is it loosening interest rates that would cause an inverted yield curve? No. Tightening long-term credit or tightening short-term credit. Where was the yields highest? In the long run or in the short run? In the short run. So of these four, the most likely cause of an inverted yield curve would be tightened short-term credit, Another way, a fancy way of saying short-term interest rates have been increased by the Federal Reserve. Let's see how we did. Great job, 100%. SIE is hard. There are 36 topics and it's a lot of information to know. Thank you so much for watching. I hope you learned something. Be sure to give this video a thumbs up. Subscribe to our channel, turn those notifications on so you know when I do the next one, it'll come to you automatically. If you have any questions about the courses that we offer, be sure to check out the link that is found in this video's description. That's it for now. Happy studies.
You got this.